Let's be honest. If you're an NRI or a high net worth investor, the India growth story is likely the loudest thing in your portfolio right now. The GDP is climbing, the stock market is hitting record highs, and your relatives are telling you that real estate in Gurgaon or Bangalore is a gold mine. But here's the reality I've seen over 20 years in wealth management. Most global investors, especially those with $1 million or more in liquid cash, are actually losing wealth in India. Not because the market is bad, but because they are playing by the old rules while the regulators have moved to a new game. I'm Kunal from EPK Capital. At EPK, we don't just chase returns, we build wealth for generations. Today, I'm giving you the 5-step checklist you must clear before you put another dollar into India in 2026. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs. You can download it by clicking on the link in the description. Step 1. Are you still using your old residence savings account? It sounds like a small clerical detail, doesn't it? But for an HNI, this is a ticking time bomb. Under FEMA regulations, the moment your status changes to NRI, your resident accounts must be converted to NRE or NRO. If you're trading stocks through a resident account, you are technically in violation. We've seen cases where HNIs face penalties of up to 3 times the amount involved. If you want to take money back to the US or UK and didn't use an NRE account, you might find your capital trapped by the $1 million per year NRO ceiling. Action item: check your bank designation today. Don't let a savings account from your college days freeze a multi-million-dollar investment. Step 2 is a hard pill to swallow. Stop treating Indian real estate as a safe haven. Rental yields in premium Indian metros are hovering around to 2-3%. Factor in taxes and currency depreciation, and your real return is often near zero. The HNI alternative: if you want real estate exposure, look at REITs or Grade A commercial real estate AIFs. They offer better liquidity and yields. In 2026, wealth isn't built by owning bricks, it's built by owning cash flow. Now, let's talk about the biggest shift in 2026. If you haven't looked at your tax sheet since the last union budget, you're likely operating on outdated math. The government has launched the Income Tax Act 2025, which fully simplifies the regime starting this April. Indexation is effectively gone for most new investments. See that 12.5% across the board? It looks simple, but for an HNI, it's a double-edged sword. The loss of indexation means you might be paying tax on a real loss. If you are an NRI selling property in 2026, apply for a lower deduction certificate, Form 13, before the sale. This ensures tax is deducted only on your actual gain. The 2026 budget introduced Fast DS. If you've missed reporting old offshore accounts, you have a 6-month window to regularize it with immunity. This protects you from the Black Money Act. That covers the first half of our checklist. Stay tuned for part 2, where we dive into relationship manager conflicts and the ultimate exit strategy. We've covered compliance and taxes. Now let's get into the most critical part of your strategy: who you trust and how you exit. Step 4 is about who you listen to. If you have $1 million plus to invest, you probably have a relationship manager at a big bank. Here is a secret: most RMs are incentivized to sell you high commission products like ULIPs or traditional insurance plans. For an HNI, these are often wealth destroyers. The sophisticated move is toward PMS or Category 2 and 3 AIFs. These structures align the fund manager's success with yours, allowing for long-short strategies even when the market takes a breather. Finally, step 5. Never enter India without knowing how to leave. I've met many families who built massive wealth but forgot to plan the exit. NRE accounts, your best friend, tax-free and fully repatriable. NRO accounts, good for Indian income, but remember the $1 million annual limit for sending funds abroad. If you are planning to move back to India, you have a golden window called Honor. For 2 to 3 years, your global income stays tax-free. Structure your global assets before you lose the status. India is the world's most exciting growth market, but it is no longer a place for amateur investing. For an HNI, the risk isn't just volatility, it's compliance and structural drag. At EPK Capital, we specialize in this exact intersection, helping global Indian families navigate complexity. We don't just look at the stock price, we look at the tax, the law, and the family legacy. Your action item: before you make your next move, do a portfolio health check. Click the link in the description or visit our website to ensure your wealth grows and lasts. Disclaimer: this video is for educational purposes only. I am Kunal from EPK Capital. Thanks for watching.